allow you to, I'm going to record this, okay? Is that okay with
Perfect.
you? Okay.
Absolutely.
Then, are you going to share your screen?
I will, yes.
If you want to go ahead, you can do it now.
Perfect. So, all right, let me go back. Let me share screen. Perfect. Well, thanks everyone for joining us today. I'm going to walk through. Yes, please.
Well, first of all, I would like to appreciate your time. Everyone here, RJ works for Toggle. He has experience in hedge fund management. He's got one of the coolest research tools that I've seen so far. It's a mixture between analytics fundamentals and artificial intelligence. All the people that are in PipTrade, Toggle has granted them access for free. This is a great opportunity for everyone, you know. In what way? Well, this is not many people has access to this, right? Like it's more for professional traders and funds. So please take advantage of it, and thanks so much for your collaboration, RJ. It's great. You know, we have great feedback from you, and I'll let you do your thing. Okay.
Well, that's wonderful. Thanks everyone for joining us. And as Juan mentioned, all of you should have access. If you don't, if you've signed up on the Google form and haven't yet received something, please feel free to shoot me a note, and we'll get it all sorted out. But we figured, Juan and I thought that, with everything happening in markets, whether the huge new unemployment claims or consumer spending and all of the market volatility that we've seen, maybe I'd walk through how we're seeing some of our institutional users use the platform, give you guys an overview, and then obviously, sort of unleash you on the platform. I think one of the interesting, so for those of you who haven't seen Toggle before, my background, I managed a discretionary global macro hedge fund at AllianceBernstein for a while. I moved into the fintech side, working for a company called Kensho, and now I'm part of this new company, Toggle. As Juan made mention, that Toggle is it's a bunch of us who either came from the tech side or the hedge fund side. The two co-founders were co-chief investment officers at a big Swiss asset manager that managed about $40 billion. And so all of us come at this from different angles, but one of the things we were all very frustrated with is that there's this vast ocean of data, and it's often very difficult for discretionary guys to manage the inflow of data and sort of what's coming through. And so the system, how you can think about it, is it's watching this vast universe of data around you. Whether it's analyst expectations or seasonality or macroeconomic factors like PMIs or unemployment, things like that. And it looks for where there are interesting divergences, right? Like recently we've had 30 million file for unemployment in the US, which is about an eighth of the total workforce. And the first time we've seen levels that high going back to the 1970s to, hey, you know what? Technical analysis in this name seems to indicate that, that it might be upward or downward. And so the system looks through this vast universe of data, finding sort of interesting up moves, interesting down moves. There's a knowledge graph on top of it, and then goes through the final analysis to say, hey, actually, where might this be meaningful for a name? And so when you first set up your account, you can go into settings, you can add in the tickers, commodities, whatever it might be that's of interest to you, and then the feed is totally customized to your names. So if we were to scroll through, we could go back to those Amazon examples, and this is entirely machine generated. We're looking at more than 9,000 assets across sort of every asset class you can imagine. So it's saying, hey, you know what? US inflation indicators are at lows. In this case, input prices PMIs. These PMIs are purchasing managers indexes. And so, what is the price of inputting things into a manufacturing process? And it says, hey, actually, anytime we've seen PMIs in this configuration before, Amazon has typically rallied. And what does that mean? Each one of these boxes is a 1 month horizon. The vertical height is a confidence interval around it. And it's saying, look, actually, anytime you've seen it here before, your downside is about 5%, but your upside might be as high as 50%. And over the next 3 months, Amazon's typically up 29%. What is this based off of? This is based off of input price PMIs being below 37. And then we can see, when has this happened before? So it's going to tell you, hey, this has happened 6 times before in the past, happened in the early 2000s, happened during the depths of the financial crisis in 2012, and then a couple of periods more recently. And then for those of you that were on Juan's talk, one of the first things you'll see is it says, hey, how robust is this pattern? And it checks it across business cycles, the hit rate, the frequency and sparseness of the pattern. What does that risk return profile look like? So sort of getting into some of the Sharpe ratio, information ratio, all of these things where it'll actually start to do an in-sample, out-of-sample backtest, showing you how does the distribution change during these periods versus the other periods. If you were to say, okay, the first time I saw this in the early 2000s, when I next saw it in 2009, what would I have expected and what actually came out of this? And then it looks at the Sortino ratio of the P&L, which is how stable would this have been over time if this was the only thing you took into your decision-making process, right? If you were solely to trade on any time PMI was in this configuration, what would have happened next? And so the system is doing all of this analysis on your behalf across any number of topics or factors, right? Whether it's technical analysis, macroeconomics, fundamentals, analyst expectations, seasonality, sentiment, volatility, right? All of these things and all of these attributes of asset prices and assets themselves are being looked at and watched by the system. I know I've thrown quite a bit at you, but I figured, the next part. So this is entirely done by machine, as mentioned. This framework holds irrespective of what we're looking at, and I thought that given recent releases and markets, there are a couple of interesting things we could look at. So one of the things that's been on a lot of people's mind is gold, and so there are different ways to navigate the platform. You can say, hey, you know what, I'm interested in a certain asset class. And so you'll get equities, commodities, currencies, fixed income, and you can click into anything like that, right? You could also say, you know what, I'm interested in metals. And you'll get any number of metals. You can also say, I just want to see more broadly in the commodity space, give me anything in the metals space. But we could say something like, you know what, I'm interested in, I want to dig into equity, and I want to look at different sector indexes in equities. So all I have to do is say that. I can say, you know what, I only want to look at actionable articles being ones that where you've seen a meaningful divergence over long periods of time. And the first one that we see is, hey, the price of S&P gold miners is at a recent high. 151.22 is where we closed yesterday. 97% of the time, this led to a fall in price. You might say, wow, that's sort of interesting. Let me dig in. And they'll say, you look, the pattern's pretty good, not excellent. It's 5 out of 7 on the quality score. But obviously this pattern seems to be reasonably asymmetric, where it looks like there are downward pressures. And then if we were to go in, it'll tell you, actually, we've been here before, right? So in the late aughts of the 2000s and going into sort of 2011, 2012, gold was on a tear back then as well. And gold miners similarly were at highs. Obviously, we came down in the interim period, but with the rally in gold that we've recently seen, we're sort of at these all-time highs again. Now, price patterns are one that it can be relatively controversial. We have some clients that really look at them, others who don't. But one of for those that do, they often think that things like this, where you've had a barrier, you're at it, it can provide interesting context where if you do break above the levels that we saw in 2012, it might actually indicate to you, hey, something's really different this time. We saw sort of similar patterns right around the early parts of the crisis, where you saw U.S. Treasuries at about 1.2, 1.3%, and when we were at those levels on the U.S. Treasury, we similarly had patterns saying, look, yields have never been lower than this before. And so actually every time yields had increased afterward. And sure enough, we broke back through, but they sort of viewed it, it's like the white whale from Moby Dick, where this is such an incredible event to sort of break through this precedent that typically it means things are going to move tremendously. Thinking about something that, today, we saw consumer spending released in the United States, and consumer spending was way down. So we can search things like, hey, you know what, I'm interested in the consumer's discretionary select sector. I want to see, have there been any patterns in consumer discretionary given what we've been seeing in some of the data and the new releases. And actually, this morning there was a pattern saying, hey, actually, consumer discretionary prices might go upward from here, similar to the Amazon one, based off of input price PMIs, so a macroeconomic factor. Where again, it says, hey, we've been here before, and actually, consumer discretionary is down today. You've had mixed earnings from some of these companies. Anheuser-Busch is way down, and several others, and actually, we've seen quite a rally up through yesterday. Today we're down. But this big down move, you could think about as actually some of the data, the underlying macroeconomic data, is supportive of consumer discretionary prices, and therefore this might actually be a good entry point into something like consumer discretionary. One of the other interesting ways we have a couple of our hedge fund clients using it is really looking cross-sectionally, and I'll show you sort of two ways we've looked at cross-sectionally. So one, in terms of currencies, you can just say, hey, you know what, I'm interested in the Aussie dollar, and then just tell me everything there is about the Aussie dollar. We've been getting quite a few patterns that are actually bullish Aussie dollar against the US dollar, against the Canadian dollar, and several others, and so those have been interesting to see. But we also, so one of the things, once you set up your daily watch, once you set up your watch list and settings, which customizes your feed, you'll receive a daily email summarizing everything that the system has found. Hey, there's a down pattern in Disney, there's an up pattern in CVS, and it allows you to click in. But we often see sort of looking through time and seeing as pressures are building upward or downward, and they sort of track it that way and thinking about that. An interesting other thing that we've done, and this is actually, this is part of the Toggle daily brief on our public website, the Toggle Global. You can come in, you can set up, you can input 3 tickers, and actually this is free and will remain free in perpetuity. So even after peep trading's over, you can sign up and keep getting it. One of the things we've been experimenting with is actually aggregating the patterns across all the US stocks that we have. So you can start to see what's the proportion of bullish patterns versus bearish patterns that we have, looking cross-sectionally across everything within the United States, and how might that be diverging from a top-down perspective, where obviously we've seen a big rally in the S&P over the last several weeks, whereas actually in the last couple of weeks we've been seeing more and more bearish patterns in the platform and fewer bullish patterns. And so, sort of interesting to think about and contemplate this sort of divergence between top-down and bottom-up patterns, and what that might mean, which is, are the overall fundamentals going to be at play, or will this macro picture and the exuberance over unlimited printing by the Fed and essentially every central bank in the globe, is that just going to buoy prices? And so even if the fundamentals, a lot of these companies are really bad, and looking to the past, anytime fundamentals have been as bad as they are, outside of obviously the big tech names, you know, you've sort of seen downward patterns. Does that sort of get washed away by some of the macroeconomic picture? And so that's, you know, that's something that we've been experimenting with quite a bit, and has been really interesting. But that's actually only a part of the free daily brief, which you can sign up for on the public site. The one final piece I'd like to show you guys, which this will allow you to do a bit of experimentation, sort of acts as a sandbox, is, you know, going back to something like that gold example. You can go into the analytics piece. You can search something like gold. You can see any number of attributes. You can look at realized volatility. We can look at return. Sorry. So we can look at realized volatility. We could look at things like, hey, you know what? I want to know gold positioning. I want to know the net virtual positioning or speculative net positioning as measured by the CFTC. And, you know, interestingly, if we look through history, positioning in gold is at a high, right? So not only has gold, the price itself rallied, but actually people are very long gold right now. And we had that other pattern in S&P gold miners. And so what this tool allows you to do is actually very quickly explore and look at, okay, we've seen this big up move in gold miner prices. I can say, hey, what does that typically mean in terms of the price moving forward from here in gold miners? We can see, hey, this happened in the late 90s. This happened in 2007, 2008, and this happened in 2016. And typically, when you've seen a rally in gold like this, gold miners continue to do well afterward. And so this is that same framework we saw before, where you see 1 month, 2 month, 3 month, 4 month, 5 month, 6 month, with the confidence intervals around it, where it's saying, hey, you know, gold rising by 50%, gold miners rising by 50% over 45 days. Here's typically what happens afterward. But one of the cool things we can do is we can actually condition on multiple things. So we could say, hey, you know what, I want to know when, obviously gold miners have had that up move, but I also want to condition it on the level being as high as it currently is in terms of positioning. How does that change the picture? And now we can see only during 2007, 2008, we have both positioning as long as it currently is, as well as having gold having rallied like we saw before. And the outcome of that is actually quite a bit more mixed. You know, the index typically, equity index typically sort of goes sideways afterward, as opposed to rallying like it did in the prior condition, which we could actually just see by turning on or off the second one. So I know I've thrown quite a bit at you. You know, I'd love to hear your thoughts or any questions you guys have. This was a very quick run through, but you know, if you don't yet have accounts with Toggle, please sign up via the Google form, and we'll get this set up typically within 24 hours. And otherwise, I think that's mostly what I had to share.
Open the chat, so I'll take any questions that are here. Okay, so is
it possible to make a portfolio? So you can't make a portfolio right now. One of the tools we're actually going to be launching soon will allow you to connect a portfolio and get insights on your portfolio throughout, but that's probably a month away or so. You know, everything is done as sort of on a watch list basis at this point.
That will mean you will be broker agnostic, right? You'll be having a
yeah, so
something like that.
Exactly. So we'll be integrated with Plaid, and so, you know, whether E-Trade, TD Ameritrade, Interactive Brokers, whatever it might be, you'll be able to get insights on across your portfolio. Oh, which platform would I recommend to operate Forex? I have no idea. FXCM used to be a popular platform, but I haven't traded Forex in quite some time. how do we compare to Bloomberg? So a lot of us come from places where we used Bloomberg quite extensively, and I think one of our motivations was whether whether you have a Bloomberg or not, a lot of the workflow is the same. You're downloading data from Bloomberg into Excel or into Python, or similarly from Yahoo Finance into Excel or Python and doing work. And so, we were very frustrated by that, and the whole system comes packaged with all of the data and all the analytics. But we also understand that most institutional guys are certainly not going to give up their Bloomberg, and so we view this as something, a tool that would augment a Bloomberg terminal. And so, we not to give exact pricing, but we, with the lower costs of cloud computing as those have come down, and the accessibility of machine learning and AI software at this point, we really think it's equivalent value to a Bloomberg terminal for about 1/10 of the cost.
I have a question, RJ.
Please.
What does your platform, how can I interpret your platform right now? Like, what is it saying?
What does it say? Yeah, so this
SPX, like.
Yeah, so it's a great question. So that's one of the things we've been thinking about is how to think about cross-sectionally both a bottom-up perspective as well as top-down. In the daily brief, as I said, this is the thing that's free and will remain free forever. We've been thinking about good ways to sort of summarize either for a single asset, saying, how do you allow someone to easily contextualize the value, momentum, growth, these sort of, the main style factors people think about, as well as, not only can the system tell you, hey, you're expensive, but actually, hey, you're expensive, and here's typically where that leads to, where that in the past has led to a bearish pattern. The system has been getting more and more bearish, the market again. We saw a big fall from a lot of bullish patterns to bearish patterns in late February, sort of right before the big crash, and over the last 2 weeks, it's similarly, in looking at breadth, right? It's been showing downward. I think one of the big conflating factors for something like the S&P 500 is that now the big tech names are something like 20% of the index, and so you have 5 names that are 20% of the index. You have 495 other companies that make up the other 80%. That make up the other 80%, right? Each one of them has a sort of a really minuscule impact on the overall index. And so, I think there are pockets that are very rosy, especially in the tech side. But I think in terms of looking at overall breadth, I think it's actually very poor in the S&P 500.
Cool, thanks. So it's what is your oil analysis?
What is our So oil has been very interesting. So I'll show you actually one of the things that has been really fascinating is and I think we've all sort of read quite a bit, but you think about carry, which is how different is oil 12 months out from now from oil at sort of spot rates. What we recently saw is sort of blowing out to unbelievable extremes we've never seen before. But even looking at this recent period, let's say when we were down to about -20 to -40, which means, hey, when you think about it in this way, you can think about the curve being so steep that the difference between spot oil prices and oil prices a year from now is really extreme. And if you think through a lot of the fundamental, underliers of this, it sort of makes sense where you say, okay, well, if oil prices are so low right now, people are going to leave it in the ground. People are going to try and buy it and store it and then sell it a year from now. And so, looking at things like this, you'd say, going back through history, you would have said, okay, it's not right. Going back through history, you would have seen, and I can actually just show you in the feed. Carry was so high that typically when you saw carry that high, the spot moved. I think one of the tough things, and so the last time we saw that was March 23rd, was when it was signaling possibly a bullish pattern in oil, up about 25% over the course of 2 months. Which actually, we haven't quite seen it there, but this is an interesting pattern because it's happened essentially once every 7 to 10 years, going back sort of with like clockwork since the 1980s, and essentially every time you saw carry as negative as it was, oil would rally afterward. Now we're actually in a very sort of peculiar, right, and you can see just how meaningful that shift in distribution was, even though you've only seen it a handful of times, but really that distribution shifts tremendously to the right. And so, I think one of the peculiarities of where we are right now is just the fact that that storage doesn't exist really. We saw oil tankers go to something like $200,000 a day to rent it, and so storage was unbelievably expensive. People are running out of places to store oil, and no one has any sense of what the demand function is. And so, with all of these things, these are tools meant for discretionary investors where, this is giving you a pixel in the broader image of your investment thesis, but isn't intended to be the be all end all of your analysis, right? This is just one piece of data that you include in your mosaic as you're thinking about, should I buy this? Do I think it's going to go up or go down? And so, none of these things are intended to be, hey, this is a trading signal. It's much more it's much more of hey, here's an interesting data point, here's typically what's happened afterward. Then you have to think about, is this time the same, is this time different, what might the similarities be, and where might we go from here.
I think we scheduled this for half an hour. But no, I mean your time.
I have probably about 5 more minutes. I can answer questions. I have to jump to something at 1:45. But is it possible to analyze the coronavirus issue? So we don't really have any time series on this, right? We don't really have any sense of what this might mean. We certainly don't really have good data on infection rates, death rates, things like that, and certainly don't have them in the platform. So that's a little bit tougher. But I think one of the things that one always can look at is things like we had a lot of patterns based off of volatility, like, right, and because obviously volatility spiked, we've seen other times when volatility has spiked relatively significantly, and so we can look at things like, hey, any time volatility has spiked, maybe let's go to less exotic cross than JPY. Well, let's stick it to equities, and you can say things like, okay, anytime we've seen volatility as high as we currently have, right? And in terms of this name, we saw it in 2015, 2017, 2018, when you have these really volatile periods, what typically happens afterward for a name. And so things like that can give you some indication of where we might go from here in terms of asset prices, because those are generally like for like periods. A really interesting pattern we had on that front was actually in VIX futures, where we had a interestingly strong pattern. So this was that the VIX had come down so significantly and so quickly that actually, we've seen this a number of times before, all sort of highly stressed periods. We saw this during, obviously, the financial crisis. We saw it in the dot-com bubble. We saw it during the quant crisis in 2007. when the US got downgraded, right? Any number of periods where you see these sort of spikes in volatility. Pardon me. Anytime you saw these sort of spikes in volatility, and actually typically when you saw a very quick reversal where, you know, sort of the VIX would blow out and then come back down, actually, you know, it sort of stayed high for quite a period afterward. It wasn't like, hey, now we're just going to go back to things as normal, VIX to 12, something like that. It actually indicated, hey, you know what, actually typically after you see these big periods of volatility, that volatility is here to stay generally for the next 6 months, right? And you know, that's sort of an interesting way to frame and think about the period that we're currently in. Probably have time for one more question if anyone has one.
Well, if there's no other question, I would like to appreciate your time, your help during these tough times. I think you're providing a lot of value to the users, and it's an awesome platform, like really is. And we're very grateful on having you as part of this program.
And you know, we're excited as well, and you know, we love feedback, we love questions, so you know, please never hesitate to send questions our way.
Thanks so much, RJ.
Thanks everyone. Thanks, Juan.
I'm gonna send these to everyone, and pretty cool stuff you showed today. Thanks a lot.
Thank you. Have a great day.